Hello everyone, and listen, if you click this video for silver news, you're in the right place. But I'm warning you up front, today is not a casual update. Today is a pay attention or pay the price kind of episode. Because in the last few days, we've seen signals that don't usually show up together. A violent repricing attempt, unusual physical premiums overseas, and the kind of behavior from banks and institutions that screams one thing: stress. I'm John A.G., and we're doing a special edition. There's a little mascot down here with me, a silver bear I've kept blind for a long time, and I promised you the blindfold comes off only after a certain milestone. We hit it, but I'm not doing the reveal yet because the stories developing right now matter more than the gimmick. The reveal is at the end, and the reason I'm making you wait is simple. What I'm about to show you explains why that milestone happened in the first place. Now, before we jump in, I need to say something politely, but clearly. My channel stats show that most of the people watching these videos, yes, most of you, haven't subscribed. And I get it. Maybe you're just passing through. But if you're getting even a tiny bit of value from the way we break this down, do me a favor and hit subscribe right now. Our target is 50,000 subscribers in the next 30 days, and it's only happening if the quiet watchers become part of the community. Quick, simple, and it helps more than you think. Also, check the description when you're done here. I've put bonus links for you down there, including a premium WhatsApp channel link and a channel membership link if you want to go deeper. And yes, we're also offering members-only videos where a separate team helps me dig into extra research and tighter data. Those videos are built for people who want more than headlines and hype. All right, here's what we're covering today. First, the price action that shocked the market and why the close matters more than the intraday fireworks. Then, we're going to look at the overseas premiums, especially what's happening in Asia, and why that price gap is not normal. After that, we'll talk about a big institution that tried to bet against silver and got humbled. Plus, what a major annual index reshuffle was supposed to do versus what actually happened. Then, we'll get into mint pricing controversy, a technical setup that could snap, and why one top voice is floating a hundreds per ounce scenario that sounds crazy until you do the math. So let's start where the story starts, the close. Because people love to argue about the top tick. They love the drama of the spike. But markets don't live on screenshots. They live on closes. And what we saw at the end of the week wasn't just a nice move. It was a message. A week ago, plenty of commentators were still acting like silver was trapped, like it couldn't hold gains, like every rally was just a setup to get smashed. And now we're in a very different conversation, with a price level that forces everyone, bulls, bears, and fence sitters, to recalculate. Just think about the emotional whiplash. Not long ago, the average person thought $30 silver was expensive. Many of you remember the basement days, when the vibe across the space was frustration, mockery, and that quiet determination to keep stacking anyway. And now, here we are, with price levels that have turned the "you're crazy" crowd into the "how do I buy" crowd. That shift matters because FOMO is not a theory, it's a force. But here's the twist. If this move was only paper-driven, you'd expect the physical market to yawn. You'd expect premiums to flatten. You'd expect the international spread to compress. And that's not what we're seeing. In fact, what's happening overseas is one of the loudest signals on the board right now. Let's talk about Asia. Because when you see one market trading the same metal materially higher than another market, two things are possible. One, it's a temporary distortion that will snap back fast. Or two, the higher price market is telling the truth, and the lower price market is still living in a story that's about to break. Now, I'm not saying we wake up tomorrow and everything reprices to the penny. I'm saying the existence of a consistent premium, especially one that persists day after day, means something real is happening under the surface. And if you've been around commodities for any length of time, you know that sustained premiums are often the market's way of whispering that physical availability is tighter than the headline price suggests. Here's the basic concept in plain language. If silver is X in one region and X plus a meaningful premium in another region, traders have an incentive to buy in the cheaper region and sell in the more expensive region. That process is called arbitrage. And arbitrage in a healthy market tends to close gaps. So if the gap stays open, it suggests constraints, logistics, taxes, supply bottlenecks, regulatory friction, or simply not enough metal moving at the speed demand requires. And right now, we're seeing that kind of gap. Reports from the ground are describing retail physical prices in some places that are far above what most Western viewers think spot even means. In several areas, the all-in retail quote includes value-added taxes, dealer spreads, and the cost of immediate delivery. But even when you strip away the taxes and look at underlying benchmarks, the premium is still there, which means the spread isn't just a paperwork issue. It's a demand and availability issue. And here's what I want you to picture. Imagine two storefronts selling the same exact product. One storefront has a line out the door and keeps raising the price, and the line still doesn't disappear. The other storefront is quoting a cheaper advertised price, but the customer experience is delays, limits, and back orders. Which storefront is telling you the real story? It's the one interacting with real buyers in real time with real inventory. Now, let's bring in another dimension, India. Because when India and China are both pulling on physical metal, the market feels it. India has a massive culture of physical buying. When households and small businesses buy metals, they're not thinking in quarterly returns. They're thinking in family time horizons. And when price rises, the Western assumption is demand must drop. Sometimes it does, but often rising prices in a commodity that people believe is essential actually increases urgency because the buyer's fear shifts from what if I overpay to what if I can't get it later? And that dynamic creates a staircase effect. You get pauses, then you get bursts, then you get a pullback that convinces the impatient people to quit. Then you get another burst that leaves the quitters angry. And the cycle repeats, with higher lows each time, because the underlying base of believers keeps expanding. Now add the currency factor. When local currencies weaken against the dollar, imported metal gets more expensive locally. That can either suppress demand or, paradoxically, accelerate it if people are using metal as a shield against currency decline. If your purchasing power is shrinking and you can feel it every time you buy groceries, the idea of owning something that isn't somebody else's liability becomes more attractive, not less. That's why the global nature of this matters. Silver isn't just a chart on your phone. It's an industrial input, a monetary metal, and a social signal. When multiple regions treat it as strategic at the same time, you get behavior that looks irrational to models built on calm periods. Now let me add a layer here that most people skip. When you have a big premium overseas, the metal doesn't magically teleport. The transfer takes time. It takes inventory. It takes shipping. It takes financing. And if banks are making it harder to wire funds for metals purchases, as some buyers have reported recently, that adds friction at the exact moment the market needs flow. What does that look like on the ground? It looks like wires flagged for extra review. It looks like purchase limits. It looks like come back tomorrow. It looks like sudden requests for additional documentation. It looks like dealers saying, we can take your order, but we can't promise delivery on that timeline. None of those things proves a crisis by itself, but together they describe a system tightening right when interest is rising. So keep that in the back of your mind because we're going to connect it to what institutions attempted to do this week. Let's talk about the big short that didn't work. Every year there's a narrative that shows up like clockwork. A big technical event is coming. Selling pressure is inevitable. Silver is going to collapse. Get out now. And every year, a certain subset of analysts and traders tries to ride that narrative for profit. Sometimes it works. This time, it didn't. A major institution initiated a bearish trade expecting downside momentum, partly because an annual index rebalancing was expected to push billions in selling into the market. The theory was straightforward. If a big index reduces its exposure, passive flows sell, price drops, and shorts win. That's the spreadsheet logic. But markets don't always respect spreadsheet logic. Markets respect who is actually buying. Because what happened next was the part that matters. Price surged hard enough that the trade got stopped out quickly, with losses that were not catastrophic in the grand scheme, but humiliating in terms of timing and conviction. And the follow-up note was even more telling. The selling pressure from the rebalance was well absorbed. Read that again. Well absorbed. That phrase is financial code for, we thought this would knock it down, and it didn't. And when a market absorbs a known source of selling, it doesn't mean the market is weak. It means the market is hungry. It means there was real demand waiting on the other side of those sales, ready to take the metal at higher levels. Now here's the cliffhanger inside the cliffhanger. If passive selling gets absorbed, then the market has effectively tested its own floor. It has said, here's the supply you warned everyone about. We took it anyway. And once that test happens, the next move can come from a higher base, with fewer weak hands left to shake out. Now, on top of that, we saw margin changes, rules adjustments that raise the cost of holding certain positions. Typically, when margin requirements go up, speculative froth gets squeezed out. And sometimes that causes sharp pullbacks. But here, the market held up. Not perfectly, not in a straight line, but with the kind of resilience that signals the bid is deeper than a handful of gamblers. And there's another piece that people forget. When price rises fast, some traders try to front-run a crash by shorting, assuming they'll buy back lower. That works until it doesn't. And when it doesn't, you don't get a gentle unwind. You get forced buying into strength. That is how squeezes begin. Not with a bang, but with denial. Now, this is where we have to talk about the physical versus paper tug of war, because it explains why so many predictions fail. Paper markets can create the appearance of supply by selling promises. Physical markets settle reality by delivering metal. When physical is plentiful, paper can dominate without consequences. When physical tightens, paper starts to feel like a story that needs constant maintenance. And maintenance means narratives, incentives, and sometimes panic. One indicator that often shows up during tightening is the price relationship between now metal and later metal. When buyers are willing to pay more for immediate metal than for future delivery, it's a hint that the market wants the stuff now, not later. That kind of structure doesn't always appear, but when it does, it's not random. It's the market putting a price on urgency. Another indicator is borrowing cost. If it becomes expensive to borrow metal, or even expensive to borrow exposure, then shorting becomes riskier. And when shorting becomes riskier, the easy trade disappears, which forces traders to respect the upside more than they want to. So when you hear someone say, "This can't last, it's all speculation," ask them, is it really only speculation if overseas physical is paying up? Is it really only speculation if known selling can't push it down? Is it really only speculation if mints are repricing and availability is flashing red? Now that leads directly into the psychology war, because the loudest voices on finance media love to frame moves like this as the top. They love to sell the fear that you're late. They love to wave a scary chart and tell you to panic. And the reason is simple. Fear sells, and fear also pushes retail into the most profitable products for Wall Street: paper exposure, managed funds, and anything with fees. But the uncomfortable truth is that physical metal doesn't generate management fees. Physical metal doesn't get rehypothecated the same way. Physical metal doesn't play nice with systems built on leverage. And that's why, when the physical market tightens, the messaging gets louder, not quieter. Now, I'm not telling you what to do. I'm not your financial advisor. I'm saying you should recognize the pattern. When narratives appear on schedule, tied to predictable events, and those narratives fail, that failure is information. So let's pivot to the chart setup, because the chart is where the next cliffhanger lives. We're watching a compression pattern. Call it a wedge, a coil, whatever label you prefer. The concept is the same. Price swings are narrowing, tension is building, and eventually the market resolves, up or down. And the reason this matters is not because charts are magic. It matters because a compression pattern is the visual fingerprint of disagreement. It's the fingerprint of a market where buyers and sellers are both active, both confident, and both running out of room. When that kind of pattern breaks, it often breaks hard, because stops get triggered, because momentum traders pile in, because the narrative flips overnight. And if the break happens to the upside while physical premiums remain elevated, you get a feedback loop. Higher price drives more urgency, urgency drives more physical demand keeps premiums high, and the higher all-in price becomes the new normal. Now, could it break down? Sure. Anything can happen in a market. But the reason I'm leaning toward up is because of the way stress signals are clustering. Let's list a few without getting lost in jargon. 1. We have international premiums that suggest physical demand is not satisfied at the Western paper price. 2. We have major selling events that were expected to crush price, yet the market absorbed them. 3. We have institutions that tried to short the metal and had to exit fast. 4. We have mints and sovereign coin programs that appear to be scrambling with pricing, availability, or both. And 5. We have the macro backdrop that makes hard assets look less like speculation and more like insurance. So now we have to talk about the squeeze conversation, because people throw the word squeeze around like it's a meme. But a true squeeze has a specific character. It's when the demand to cover short exposure collides with an inability to source the underlying asset, creating forced buying at rising prices. It's violent, it's fast, and it makes everyone who thought they had time realize they didn't. Have we had that? Not fully. What we've had is a long, grinding regime where physical demand has been persistent and supply has been constrained. That can drive a major bull market, but it's not always a cinematic squeeze. A squeeze is more like a trap door opening. But here's why the squeeze talk is back. When price approaches psychological levels, like $100, several things happen. Retail attention spikes, media attention spikes, derivative positioning changes, and new products get pushed at the public to try to direct that attention into paper instead of physical. You've already seen signs of that. Announcements and marketing around contracts that make it easier for smaller players to participate without ever touching metal. And I want you to think about that for a second. If everything is normal, why the rush to create new paper vehicles right when physical demand is loudest? If everything is fine, why not encourage delivery? Why not celebrate the physical market? The existence of these products isn't proof of anything by itself, but the timing is interesting. Now here's where a lot of people get lost, so let me keep it simple. Everyone wants a single catalyst, a headline, a villain, a hero. But big moves in metals usually come from layers stacking on top of each other until the market can't pretend anymore. Layer 1 is basic supply and demand. Silver isn't like a meme token where supply can be created with a click. Mining takes years. Permits take years. New production doesn't respond quickly to price the way people assume. And at the same time, industrial demand doesn't politely step aside. Electronics, energy infrastructure, medical applications, and all the modern life stuff that quietly depends on silver keeps pulling ounces out of the system. Layer 2 is inventory psychology. In normal times, metal sits in vaults and moves around on paper because nobody cares about immediate delivery. In stressed times, the question changes from, what's the quote, to, can I actually get it? That's when the market starts to distinguish between metal that is truly ready to move and metal that is technically counted but practically unavailable. You don't need to memorize categories to understand it. You just need to know that not every ounce on a spreadsheet is truly for sale at any moment at any price. Layer 3 is positioning. When too many players are leaning the same way, especially leaning short, price doesn't need a miracle to rise. It just needs a spark. And the spark can be something boring. A strong close, a surprise premium overseas, or a rebalance that fails to break support. That's why this week mattered. It wasn't just a rally. It was a your playbook didn't work moment. And then there's the wildcard layer, policy. Governments and central banks can change sentiment overnight. A statement about rates, a sudden liquidity program, a banking stress headline, a geopolitical flare-up. These aren't reasons to panic, but they are reasons to respect volatility. Silver reacts fast because it's smaller, thinner, and more emotional than gold. When the crowd rushes in, the door is narrow. So what does that mean for you, the viewer sitting at home? It means you should think in scenarios, not certainties. Scenario 1, we grind higher, consolidate, and then push through the next psychological level with momentum. Scenario 2, we spike, shake out, and then reclaim higher levels after forcing weak hands to quit. Scenario 3, we get a surprise dip that looks scary on a chart but doesn't change the physical story, and that dip becomes the moment you wish you had planned for instead of reacting. Because here's the honest truth. The worst decisions in metals are made in a rush. Chasing a pump feels good for 10 minutes and terrible for 10 months. Panic selling a dip feels like relief until price rips back without you. The winners aren't the people with perfect timing. The winners are the people with a plan. That's why I keep pushing the community angle. If you're new here, don't lurk alone and guess. Use the comments. Use the membership if you want deeper breakdowns. Use the bonus links in the description, including the premium WhatsApp channel, so you're not reacting to rumors in isolation. When markets get loud, information quality matters. And let me give you a practical example of how this plays out at street level. When price moves fast, some dealers widen spreads or pause quotes because they can't hedge instantly. Some platforms show out of stock, not because there is zero metal on Earth, but because replacement cost is unknown for the next shipment. That's when you see weird moments where spot is one number and the real-world buy price is another. People call it a scam. Sometimes it's just volatility plus risk control. Either way, it changes the behavior of real buyers, and that's the signal. So if you're expecting fireworks, do yourself a favor. Decide ahead of time what you'll do if we see $100, what you'll do if we see a pullback, and what you'll do if premiums explode. Your future self will thank you. All right, keep all of that in mind, because the next segment, about the price reset and why this might be the early innings, only makes sense when you realize the system has been living on calm assumptions for a long time. Now, let's zoom out to the macro, because this is where the price reset idea makes sense. One of the smartest ways to frame what's happening is this. Silver is not simply rallying. Silver is adjusting to decades of mispricing. That's a bold statement, but the evidence for long-term suppression, fines, and manipulation cases has been public for years. So when people say, this can't be real, you have to ask, real compared to what? Real compared to the most managed period in modern market history? If the baseline was distorted, then the move back to equilibrium feels extreme, even if it's actually just normalization. And here's the bigger macro anchor. Since the early 1970s, the purchasing power of paper currencies versus hard assets has eroded dramatically. Not in a straight line, not evenly, but persistently. And the most important part is this. A huge portion of that erosion occurred while debt was building, while deficits were growing, while obligations were piling up like dry tinder. Now we're in the next chapter, not the accumulation phase, but the servicing phase. Interest expense, refinancing, rolling deficits. That's where systems start to wobble, because it's one thing to borrow, it's another thing to maintain confidence when the bill arrives. And when the bill arrives, policymakers have a limited menu. They can cut spending aggressively, raise taxes aggressively, default outright, or debase quietly. Historically, the quiet option wins. Call it money printing, call it liquidity, call it supporting markets. The label changes, the effect is the same. More units chasing the same real stuff. That is why hard assets keep coming back into the conversation. Not because of conspiracy, but because of arithmetic. Now, speaking of real stuff, let's talk about the mint pricing controversy, because this is where people get emotional. You've probably seen the screenshots. Certain official coin programs listing coins at prices that feel absurd compared to spot. And people immediately jump to one of two extremes. Either they're ripping everyone off, or this proves the system is collapsing tomorrow. Reality is usually messier. First, some of those listings are premium versions, proofs, special finishes, collectible variants. Those have always carried higher prices. But here's the part you can't ignore. Even regular versions, when available, are showing prices that look like they were designed for a different world. And availability tags, not available, sold out, back order, keep popping up in ways that suggest adjustment lag. Now add the dealer layer. Dealers are not charities. They hedge, they manage risk, they protect inventory. When volatility spikes, spreads widen. When supply is uncertain, premiums rise. When replacement cost is unknown, the safe move is to price higher until you can restock confidently. That's not evil, it's survival. But it's also a signal. It's the retail market admitting that the paper quote doesn't represent the cost of reloading inventory under stress. And then you look overseas and see sovereign coins priced at levels that imply retail buyers are willing to pay a huge spread for trusted products. In some cases, the all-in price per ounce equivalent is stunning. Could part of that be taxes and distribution? Yes. Could part of it be supply chain and hedging? Yes. But at the end of the day, the consumer doesn't care about your breakdown. The consumer cares about what it costs to actually get metal in hand. And when the cost to get metal in hand detaches from the paper quote loses authority. Now, keep that thought because it connects to the $500 silver conversation, which sounds insane until you understand what the analyst actually meant. The claim isn't silver must go to $500 because vibes. The claim is that silver has been stuck under a historic ceiling for so long that breaking it changes the probability distribution. It changes what becomes possible in a momentum environment, especially if gold is also moving and if the relationship between the two metals shifts. There's an old way of thinking about the gold-silver relationship. Silver trades at some percentage of gold's price. That percentage has expanded and contracted across decades. If the percentage shifts upward, meaning silver strengthens relative to gold, the nominal price can climb faster than most models anticipate. And that's why people are now talking about scenarios that would have sounded like comedy in the old days. Because if gold rises and silver's relative strength increases, the math gets dramatic quickly. Even conservative assumptions can spit out triple-digit numbers. And the more dramatic assumptions, yes, can put hundreds on the table. But let's be honest about something else. These moves, if they happen, are not gentle. They are messy. They come with volatility. They come with shakeouts. They come with fakeouts. And that's why the most important thing is not predicting an exact day. The most important thing is recognizing the regime shift when it's happening. Now, I want to pause here and ask you two questions, because I want you in the comments on this one. First, do you think $100 is the line that flips public attention from niche to mainstream? Or do you think the mainstream doesn't care until it's far beyond that? Put your answer below. Second, if we get a sharp pullback before the next push, would you view it as a gift or as a warning? Tell me how you'd react, because your answer will tell me what kind of market participant you are. And while you're commenting, if you're someone who has actually done well, maybe you stacked early, maybe you bought miners at the right time, maybe you flipped premiums, maybe you simply stayed consistent, share a quick success story. Nothing flashy, just real. Because when people see others winning with discipline, it raises morale and helps the whole community think longer term. Now, let's connect the dots to the banking friction, because this part has been under-discussed. When buyers report that wiring funds for metals purchases is getting more difficult, or that compliance hurdles are rising, it could be normal bureaucracy. Or it could be something else, a system preparing for increased demand, increased scrutiny, and increased risk. Metals are not just a product, they're a statement. They're an exit ramp from pure trust in paper promises. And systems that run on trust get nervous when too many people look for exits at once. If you've never seen a liquidity event up close, here's the clue. It often starts with small inconveniences, delays, limits, extra forms, confusing policies. Then suddenly the inconveniences become constraints, and constraints create urgency. So again, I'm not telling you tomorrow is the apocalypse. I'm telling you that friction plus rising price plus physical premiums is a cocktail that has produced fireworks historically. Now we're almost at the reveal, but I still need to deliver one more friendly reminder, because some of you will skip this and then ask me later. The bonus links are in the description. The premium WhatsApp channel link is there, the membership link is there, and the members-only videos are real. We've got a separate team working on them, digging deeper so premium members get tighter research, not recycled talking points. If you want that, check it out. And again, we are pushing for 50,000 subscribers in the next 30 days. If you're watching and you're not subscribed, you're basically telling the algorithm, don't show me this. So if you want more of these updates, subscribe and turn notifications on. Short and simple. All right. The blindfold. This bear has been sitting down here as a symbol of patience, of discipline, of seeing through the noise. And today, the reason the blindfold comes off isn't because I want a cute moment. It's because it marks a psychological chapter change. When a market crosses a level and holds it, it forces a re-rating. So here we go. I'm going to lift him up so you can see. And yes, there's a little surprise under the blindfold because of course there is. But first, one last cliffhanger. If the next leg really does begin, the metal that moves people from curiosity to panic isn't gold, it's silver. Silver is the one that makes people say, wait, I can still afford this? Until they can't. Okay, count with me. 1, 2, 3. And there it is. The blindfold is off. And the surprise? Those aren't ordinary eyes. Those are tiny silver pieces I tucked in years ago as a joke, and I honestly forgot they were there until today. But it fits perfectly, because that's what silver does. It sits quietly, ignored, until suddenly it's staring everyone in the face. Now, if you made it this far, you're exactly the kind of viewer this channel is built for. Leave a like so this reaches more people who need it. Subscribe if you haven't. And drop your answer to those questions below, especially the one about $100 and the one about pullbacks, because your perspective helps shape what we cover next. I'll keep tracking this weekly, but only if you keep me honest in the comments. And again, if you're successful, share a win in the comments. It doesn't have to be huge. It just has to be real. That kind of feedback keeps the community strong. All right. Take care of yourself, take care of the people around you, and I'll see you in the next one.